Hi, this is Todd Baker, your certified mortgage planner. And today I want to talk to you about traditional sources for down payment and closing costs when you're buying a home. So the way it works is traditional sources would be depository accounts and non-depository accounts. And the basic elements that have to be verified in any mortgage are going to be on a depository account. And what a depository account would be, generally speaking, it's going to be a checking and savings account, right? So you have to go back 2 months. But part of the reason you want to do a pre-underwrite of your file is any large deposits over the last 2 months have to be sourced. Sometimes those are easy, they're large payroll deductions. But if you have a big cash deposit, I'm going to show you in a minute, cash may or may not be a viable source. So what determines whether the funds can be used or considered what's called eligible funds or non-eligible funds are based on written guidelines. I wanted to show you real quick what that looks like, what we look at as lenders. So just to give you an example, for a Fannie Mae loan, there's stocks and bonds, trust accounts, retirement accounts, personal gifts, gifts of equity. There's a whole list. And if you look each one of these, for example, go on the personal gifts, we'll show you a borrower can basically use gift funds to purchase, but it has exactly what has to be done. Gifts provided by a relative, fiance, or domestic partner. It literally lists out the who's an acceptable donor. What the minimum borrower contributions are, if any. How to exactly document the gift. And so I want to talk to you about two areas of funds that most borrowers don't consider on a traditional basis. So number one would be a 401k. So you saw a retirement account listed. So a 401k is a great source. Many of you will have a 401k, and the way it works is the way the IRS set it up, regulatory speaking, is you are allowed to withdraw the funds without paying a penalty if you're buying a home. You might say first-time home. You have to check your guidance and your plan summary. But that's considered usually under the hardship section. It'll say, hey, if you're buying a home, you can withdraw funds. Now, you're still subject to what's called ordinary income tax. And what that means is at the end of the year, you get I think it's a 1099, it's the form they send that says, hey, there's this distribution taken, and that has to be considered on your tax return. But what I can tell you is for most people, because of the other deductions you get for buying a home, it's really not a big impact as far from a tax point of view. It's something you have to talk to a tax person about. But I'm just telling you what I see. I don't see a big impact normally. And you get to avoid the 10% penalty. But there's another way that I like equally as well, if not better. All plans will allow for you to borrow up to 50% of the amount in your 401k. Usually it's capped at $50,000, and you pay it back over 60 months with a very small interest rate, very low interest rate. The administrative cost is usually less than $100 to set it up. And here's the cool thing, you're paying it back to yourself. You're literally paying yourself back that loan. It's really cool. So it allows you to borrow some money to buy a house. You still have your 401k intact. 60 months, take it off the top of your pay stub. You won't even notice it coming out of your check. And you can pay it back anytime. So that's one great source of non-traditional funds. Another great source is a gift. Okay, so what that looks like is, I showed you have to find an acceptable donor. It's typically a family member. It could be a cousin, but you saw the list, and FHA has a similar list. All loan programs basically have the same elements. But what you're going to do is you locate the family member, and here's how you document it. They have to be able to provide a bank statement. So make sure you set that proper expectation, because that's the number one thing that people object to is like, hey, I don't want to get my bank statement. I don't know these people. So what I always do is, hey, you can send it directly to us through encrypted email or upload, or you can bypass the recipient. Sometimes like a mom and dad or a relative, they don't want you to look at their account. They can send it directly to us. That's how I get around that normally, or make the donor feel comfortable. Although most people don't mind. Most people don't mind. So it's donor bank statement. There's a form you fill out just saying it's a legitimate gift, and then you have to document the transfer of the funds. That's a great source of money. And let me tell you, a gift is for loan purposes. It's not an IRS gift. It's just you're not allowed to borrow money for your down payment. So that's why it's a gift. But there's nothing that says that you cannot gift that back to them or pay them back. It just can't be a loan. It's still a gift, but it doesn't mean you can't pay them back. So bottom line is those are two great sources of getting funds that you normally wouldn't think of beyond all the other traditional sources. And I showed you just real briefly, when we pre-underwrite a file, those are the kind of things we do. We look at the assets very detailed relative to the written guidelines. So hope you found that helpful. Please feel comfortable reaching out to me if you have any questions, you need any help. I'd be happy to assist you. Have a great day.